Vincent Deluard. I'm the global macro strategist for INTL FCStone, which is a global financial service firm working the securities team, advising institutional investors on asset allocation, sector selection, and so forth. I'm based out of the Bay Area, where I live for the past 10 years.
What is rotten in the state of California?
I think it's the entire model of the Bay Area economy of kind of rising asset prices, very high wages, most of that being stock-based, and very high real estate prices. And it was somewhat of a virtuous cycle for most of the past 10 years. And with the recent slaughtering of the unicorn, I think we're at the beginning of a massive unraveling of this model. WeWork is like WeWork is not San Francisco, but it is the tip of the iceberg. I mean, you see the big public ones that catch everyone's attention, but I mean, the way Silicon Valley works is almost like a pyramid scheme in a way, where every valuation is based off someone else's valuation. So if one needs to take a write down, then the entire chain needs to work its way down, and then a lot of this wealth is on paper. And it's very hard to use traditional discounted cash flow models for companies that don't have cash flow or have cash flows that are very negative for as far as the eye can see. So you really have to price them off other deals. Most of the bubble that we've seen, contrary to what happened in the late 90s in the private market. But that being said, the IPO remained the end game, right? It's just been longer and longer. You had all these Peter Pan companies that, have been funded by private investors for, 5, 10 years. I mean, when it started, you only had Series A, B, maybe C. I mean, now people are F, so, and all these companies now, basically the road to a public listing is now closed. And the large investors that could bring them that liquidity, typically the Vision Fund, are just not doing so well. A lot of them use leverage. So I think we are just at the beginning of this unraveling, and I don't see a happy ending to this.
What started the massacre of the unicorns?
That is an excellent question. I mean, probably, it's one bridge too far. I mean, the big IPOs were priced too aggressively. And the excesses have just been, WeWork is kind of the poster child of really the end of a cycle, if you will. I mean, I think initially, if we look at the first stage of the unicorn massacre this summer, it somewhat made sense because we had these steeper yield curves and higher yields. Now, I think it was actually in WeWork S1. It was probably the biggest chart crime I saw in a S1 filing. There was no y-axis, so it was a chart of one, and I think what it was meant to represent was the expected cash flow of WeWork, and then it was very negative for 3-4 years, and then it just shot to the sky. No, like I said, no unit, no currency, no nothing. But the point is, if you have a cash flow profile like that, which is what most unicorns think they will have, the best configuration for you is an inverted yield curve, right? Because you discount your losses at a higher rate, and then your profit, which come later, are discounted at a lower rate. So if you take a net present value approach, this is the yield curve that will maximize your net present value. So when you have a yield curve steepening, which is what we had early in September, that just throws that dynamic upside down. So that was somewhat logical, but then something strange happened in the past, I would say 3-4 weeks, is that we've seen the long bond rally, we've seen flattening, if not inversion of the yield curves, and yet the unicorn massacre kept going. And in a way that kind of reminded me of what happened in 06, 07 with the real estate market. There was this famous quote by Ben Bernanke, I think it was in his Chicago speech, so I think the subprime problems will be contained. And that was not such an unreasonable thought at the time, because at the time you could, I think the Fed had just hiked 20 times in a row. Yeah, we could probably cut a couple times and we'll be fine. But then the surprise was that as the Fed cut, subprime trouble kept getting worse, not better, and that's because there was just, the math didn't work. Right? These guys were not going to pay. So even if you cut it to zero or below, it was still unaffordable. And I think that's probably what's happening now with some of these unicorns is people are realizing that negative cash flow at a negative discount rate are still negative present value.
Is the problem contained to the Bay Area?
I would expect San Francisco to be the epicenter of this, and maybe we'll get into this later, but partly because of the role played by equity-based compensation. I think that's kind of the missing link, and that's the leverage that takes something that should be a welcome valuation correction, right? I mean, you had this bubble. It's somewhat of a healthy thing that it corrects, but that will translate that, at least within the regional economy. Past that, I mean, lack of profit is not just a unicorn startup-y phenomenon. If you look at the Russell 2000, about a third of Russell 2000 companies do not make profit. I actually, I counted, there was about 18% of the companies that lost money in 15 of the past 16 quarters. That's a significant number. And they're not just tech startup or biotech companies. And again, you have this, I mean, we have tax rates at the lowest they've been since the end of the war. We have the unemployment rate at the lowest it's been for, again, the end of the war. Interest rates at about a 5,000-year low. And still you have a third of the market that cannot turn a profit under the circumstances. And at the same time, you've seen this explosion in debt per share, 3-4x on the Russell 2000 since 2011. So you have all the ingredients for I think, a major correction.
The effects of stock-based compensation in the Bay Area.
Absolutely. I mean, to me, this is one of the most fascinating stats that really doesn't get talked enough, is the amount of dilution and stock-based compensation that's being paid out. And part of the reason it doesn't get discussed as much is if you look at big tech, there's usually a buyback to offset that. So you don't really see that in the number. Like you have to dig through, wow, they're spending all this money on buybacks, but the share count is flat or growing. And then you realize, that's because they pay so much of their comp and stock-based. I mean, I think if you look at like a mid-level data scientist at Google, probably makes, 400K, I would think. And I would say half of that is going to be stock-based comp. Same would be true at Amazon and other places. Now, when the stock price goes up, that is wonderful. But as you mentioned, this expense has grown much faster than any other, whether it's revenue, whether it's earnings, cash flow. So I made this amusing calculation that if we kept going at the current pace, so I built this index of Bay Area-based companies. I found that they paid $18 billion. Now, $18 billion in one quarter in stock-based compensation. Now, $18 billion is a significant number. I mean, it would be, I would say, about 1% of French GDP for that matter, just in one quarter in maybe 4 zip codes being paid out, right? So, and again, keep in mind that the absorption capacity of the Bay Area in terms of our real estate assets is quite limited, right? So this is a wall of money that just falls. Anyway, and if they kept at this pace, it would take 5 years until which they would pay more in stock-based compensation than they would have earnings. If earnings kept growing at the healthy pace that they are, and then stock-based compensation keeps, skyrocketing as it is. So obviously we had a problem. Like you would need an infinite amount of growth to sustain these practices.
How has this affected the housing market?
We had the first cuts in the second half of last year. And then we've seen the K-share rebound everywhere, but 3 cities, San Francisco, Los Angeles, and Washington, D.C., which are coincidentally also the ones that had seen the highest appreciation. We may be at this point where rate cuts have lost their ability to make people solvent again, and I wonder what will happen to the employees that were happy to take this very, and it's a nice life. I mean, when you work at Google or Netflix, I mean, you pay a lot of money, but again, half of your compensation is in equity-based options. And, if suddenly this is not worth anything, well, you may ask for real money instead of options. And that will be a problem for all those companies that don't make any money, that just won't be able to do it. And those they do, the companies who do make money, part of the appeal of big tech is high margins and high growth. Well, if suddenly your employee expense, which these are not like capital-based industries, the biggest expense is their people. If that doubles, then the case for these high and resilient margins just goes away. The EPS growth drops, and then you could see this kind of negative feedback cycle. You could also see it go through taxation. I think San Francisco gets about a third of its revenue from various housing and transaction-related taxes. And basically the virtuous cycle of the 2010s could be the vicious cycle of the 2020s.
Is this being driven by millennials?
One thing that struck me is if you look at the median millennial, he turned 20 in 2009 when the S&P 500 bottomed at 666. And then last summer, that same median millennial turned 30, just as the S&P 500 broke through 3,000. And I like to put it in these terms that, this was, in a way, a millennial bull market. And, we get a bad rep as millennials, but we ruin everything, sex, beers, whatever a boomer is grumpy about, is being ruined by millennial. But that's the one thing we did right, is bull market. And in a way, it makes sense. I mean, the millennial is the greatest generation. It's not the boomers. You have more millennials than you have boomers, at least in the U.S. So you have the greatest generation in American history going from an income of zero or even negative when you're 20. I mean, you really don't have an income. You have a bunch of expenses and that's it. To your 30s, when really this is a time when your earnings start to slow or even sometimes peak. But during these 10 years, your income grows, I would say, double digit every year. If you think about who was shopping on Amazon first? I mean, it was people my generation who, my parents would have had an AOL or the French equivalent email account. I would have switched already to Gmail. Who was Facebook initially was for really millennial. I mean, you needed to have a U.S. university, actually Ivy League at the beginning, email address to join. And Netflix obviously has, the boomers would, a date would be a dinner and a movie. And then for the millennial, it would be, let's watch some Netflix together. So these were millennial companies, and they rode this enormous wave in this generational rise of income, and that's why growth seemed effortless for them. And I think we're seeing the end of it. I mean, the best example would be Netflix, where for the first time in the most mature market for them, the U.S., you saw this subscriber decline and the need to raise prices. The best historical analogy to me would be the Nifty 50s. So this was back in the late 60s, early 70s. And this was a prior greatest generation, which is the boomers. Same story. So the boomers were born starting just in the middle of the war, 1942, I think is the first year for the baby boomers. And as the baby boomers started spending, you see this rise of consumer companies. At the time, it was Walt Disney, Coca-Cola, Gillette, and they were touted as this one decision stocks. Like, it doesn't matter what the price is because they would always have the growth to support that. And then by the time you get to the mid-70s, well, it turns out that the boomers, also had to pay houses, also had to raise children, and the growth it was like the air, like when a plane hits a turbulence, just drops like that. And that's certainly something we're seeing with if you look at a composite of the sales growth of the FANG stocks, the gap with the rest of the market is at the lowest it's ever been. And I think part of the game then is going to be, okay, are we able to appeal to this younger generation, Gen Zers, I believe, and I think some of certainly, like if you think about, Facebook buying other social networks, they can probably do that, but that generation is much smaller. So just by a sheer demographic effect, you'll see an adjustment in growth rates.
A golden age for millennial consumers?
It's been marvelous for someone like me. I mean, it's assisted living for the young professional. I mean, you you literally have, and I still, it will take many historians to explain why the world thought that was a good idea to take the savings of, pensioners in Japan and Germany and use them to subsidize the consumption of yuppies in New York and San Francisco. But that's effectively what a lot of these, if you think, maybe not the FANG, because the FANG do have a, profit-generating ability, but if you think about the more consumer-centric unicorns, like, well, it's not really a unicorn anymore, but something like a Blue Apron or a Casper or even Uber or Lyft, where effectively the product is being subsidized indefinitely in order to win market share, it is a subsidy. And as a recipient of this subsidy, I'm obviously in favor of it. But I wonder whether in some of these companies, it's really the Peter Pan syndrome, right? Where they never grow up, they never pass this phase of, we're just building out. Like, I mean, WeWork is an example, right? We need to spend $2 for every dollar we earn. If you remember from the internet bubble, right, the joke was Pet.com, right? They had the Super Bowl ad, and it was kind of cringy. And basically the story was like, I think they had a revenue of, and the numbers were tiny compared to what we're seeing today, but I'm going to say 100 million, but it was not sure. And then they have COGS of 160 million. So it's like, congratulations, you took something that was worth 1.6, you sold it for 1. That's your business model. Well, 10x that, and you get WeWork.
How does this relate to what you are seeing in the Bay Area? Again,
I would work off the 70s analog, because in many ways it's somewhat similar in terms of at least the demographic aspect. And the biggest thing in the 70s was, these companies didn't go under. A lot of them are still members of Dow Jones. But the multiples went, and again, the Nifty 50 is traded at 50, 60 times earnings, very similar to what you'll get for Netflix or Amazon today. And as you re-rate that growth, the multiple just needs to come down. So you need to see a massive adjustment in valuation. And then because of this kind of unique dependency of the Bay Area on stock-based compensation, which I don't think was as prevalent in the 70s, I think you could see a wider impact, certainly on the local economy. And another added risk factor in the 2020s that was not present in the 1970s is high level of debt. You've really seen this explosion of debt per share in pretty much all across the board, which will make companies much less resilient to this kind of re-rating of multiples.
The new value investing.
One experiment I made, came from a frustration with traditional factor investing, which, as you know, hasn't really worked, right? I mean, most multi-factor ETFs really haven't worked. The only factor that's worked has been momentum, and that reversed last summer. So I was thinking, instead of like back testing things and calling them anomalies, maybe we should understand the term factor in a more literal manner. What makes value? And fundamentally, you can break down value. It either comes from capital, labor, or everything else, right? I mean, there's nothing else. So I build these portfolios. I form portfolios, typical factor work based on decile, which companies have the most market value per capital, the most capital per market value, the most labor per market value, and then the most nothing per market value, right? And all the way up until for most of the simulation period, buying capital on the cheap or labor on the cheap was the best strategy. And again, that's basically the value anomaly, right? Buy low, sell high. And then as you move towards the 2010, what you start seeing is intangible capital being the driver of return. So things like patent, like copyright, and that's consistent with the rise of big tech companies that really don't have that much capital. They have employees, but still on a adjusted per the market cap, it's very low. So most of it is intangible. And then starting in 2015, the best strategy is the one that used to be the worst strategy before, which was buy the companies that have neither capital, nor labor, nor even intangible capital. They have nothing. But I think in a way, I mean, you can call that a bubble, and you can say maybe it's because of, passive indexing, because of the death of the value investor, because maybe all these things are true to some extent. But I think more fundamentally, it happened coincidentally with the rise of these negative yielding bonds, which is 16 trillion today. And I think what it says is like, when capital becomes free, owning stuff is not an advantage anymore, right? I mean, having a big retail network anybody can do that. Anybody who has access to borrowing can replicate this. So what defines value then becomes, the things you cannot replicate. So it could be, reputation, data on consumers, brand, loyalty, and so forth. And I think that's what this was capturing. Oh, it could also be just an illusion. And the piece I mentioned was referring to, I call it the Fire Festival stock market. We're all living in this world where, we tell stories to each other. And as long as we all believe that, Fire Festival is going to take place, everyone's happy, the influencers are happy, the organizers are happy, the musicians are happy. It's only when... and I worry that we are getting at this Fire Festival moment with the collapse of the unicorns.
The best of times or the worst of times for millennials in Silicon Valley?
The most interesting statistic is the one you brought up, where you see the stock-based compensation growing 4 times faster than market cap, which itself is growing 3 times faster than earnings, and to be facetious, I added a chart. You can actually, that's the beautiful thing about San Francisco, is it can't clean its street, but you can track poops in real time. So they had this service called 311.org where you can report any incident. So actually, you really don't need to be a great coder to do it. And I plotted that next to the stock-based comp, and you see this almost one-to-one correlation between stock-based compensation and reported incident involving human feces in the streets of San Francisco. You also have the same thing with discarded needles. As you know, there's a huge homelessness crisis in San Francisco. The city doesn't quite... Well, I think they know how to address it, which is to build house. Really, they just don't want to. So one of the solutions is to just give them needles. And I think at the current pace, it's about 2 million needles a year that are being discarded in the streets. Anyway, and the reason I like to bring these two together, other than the shock value, is to really speak to that. We started by saying there's something rotten in the state of California, and I think it's something that you'll feel when you talk to people. The sense that this should be the best time. This should be Silicon Valley should be the model for this brave new world. Everyone talks about this crisis of capitalism, stagnant wages, rise of populism. I mean, the Bay Area should be this shining city on a hill with people living happily in suburban houses, driving Tesla and stuff. And it's shocking when you talk to people. There is this sense of pessimism, of self-rejection almost. They don't want their kids to be anywhere near iPads. There's this almost sense of guilt that this big tech is destroying society as we know it. And politically, you kind of see that with Andrew Yang's candidacy, which everybody, all my friends love Andrew Yang. And in a way, it reminds me a little bit of the when the Pope was building St. Peter's in Rome. The church needed money, so they sold indulgence. So give the church your money, and you'll earn a couple of years in paradise, and your sins will be forgotten. I feel with the universal basic income and its enthusiastic embrace by not just big tech people, but regular employees, like, oh my God, what have we done here? Hopefully, here's my $1,000 a month indulgence to redeem my sins.